Welcome, weary traveler of the day, to a space carved out just for you, a sanctuary where the relentless hum of the world outside fades into a gentle whisper. You've reached a point where the mind, after a long day's engagement, craves not just rest, but a different kind of nourishment, one that soothes the conscious while subtly engaging the deeper currents of thought. This is not your typical bedtime story, spun from fairy tales of old or fantastical adventures. Instead, this is an exploration, a quiet voyage into the hidden mechanisms that have shaped human endeavor across millennia, focusing on a concept that often eludes our conscious grasp when our eyelids grow heavy: the ceaseless nature of prosperity. We often associate financial growth with the hustle, the grind, the waking hours of diligent effort. But what if there's another dimension, a silent engine that works while we dream, a prosperity that blossoms in stillness? Tonight, we're going to delve into that very concept. We'll trace the threads of financial evolution through time, not through dry economic treatises, but through the evocative echoes of history and the enduring whispers of legend. Imagine, for a moment, stepping away from the immediate demands of your life, from the to-do lists and the urgent notifications, and allowing yourself to simply be present, to listen. This story is crafted to be a companion to your transition into sleep, a gentle hand guiding you through narratives that are both ancient and remarkably relevant to our modern lives. We're going to explore how, for centuries, wealth has been cultivated and compounded, often with a patience that mirrors the natural world, with a rhythm that understands the power of delayed gratification. Think about the agricultural cycles of the ancient world, how land, left to its own devices under the watchful care of nature, yielded its bounty season after season. Consider the quiet accumulation of knowledge, the slow burn of innovation that laid the groundwork for future advances. These are not stories of overnight success, but the profound, often unseen, processes that build enduring value. This journey will take us from the sun-drenched fields of Roman estates, where the land itself was a silent partner in generating wealth, to the hushed halls of early banking, where the simple act of entrusting one's savings became a seed for future prosperity. We will brush past the shadows of merchant guilds, where reputations were built over generations, and touch upon the early seeds of industrial enterprise, where investment, even in its nascent forms, began to work its magic long after laborers had retired for the night. The core idea we'll be exploring, the fundamental principle that will weave through each narrative, is that time itself can be an ally in the pursuit of financial well-being. It's about understanding that while our conscious efforts are vital, there's a parallel universe of growth that operates on principles of patience, of strategic seeding, and of allowing processes to unfold naturally, much like a complex organism maturing over time. This exploration is designed to be a calming balm for a mind often overstimulated by the constant demand for immediate results. By shifting our focus to the long term, to the power of cyclical growth and the quiet accumulation of value, we can begin to recalibrate our understanding of prosperity. It's about recognizing that just as sleep is essential for physical and mental restoration, there's a financial equivalent, a period where investments mature, where strategies bear fruit, where wealth, in its most profound sense, can continue to grow out the constant anxious intervention of our waking minds. The intention here is not to offer magic formula, but to cultivate a deeper intuition, a subtler awareness of how wealth has historically been built and how, by understanding these ancient rhythms, we can integrate a sense of serene confidence into our own financial lives. So, as the light begins to dim and the world outside grows quiet, allow yourself to sink into this narrative. Let the words wash over you, not as a task to be completed or a problem to be solved, but as an invitation to a different kind of understanding. We are about to embark on a gentle exploration, a story for the awakened mind that seeks to unravel the subtle arts of financial patience and enduring growth. This is about more than just money. It's about time, about nature, about the quiet power that resides in the intervals between our actions, a power that has been shaping fortune since the dawn of civilization and continues to do so, even as you prepare to drift into a restorative sleep. Our narrative begins not with a bang, but with the slow, steady turning of the earth under the vast, indifferent sky of the Roman Empire. Imagine sprawling agricultural estates, the latifundia, vast tracts of land that were the backbone of Roman wealth. The real magic, however, wasn't solely in the manual labor of the day, though that was crucial. It was in the understanding of agricultural cycles, the planning that extended far beyond a single harvest. The Romans were astute observers of nature and masters of long-term investment. They understood that planting a vineyard was not about immediate consumption, but about nurturing a plant that would yield grapes for decades, its value compounding year after year as it matured. The olive groves, too, were a testament to this philosophy of patient wealth creation. Once planted, these trees required consistent care, yes, but their production was a steady, ongoing stream of income, a resource that literally grew while the owner might be engaged in other pursuits, perhaps even resting or attending to civic duties. Think about this for a moment. The ancient Roman landowner, perhaps sitting in his villa, the sun setting over his extensive holdings. He might not be physically toiling in the fields at that very hour, but the potential for wealth was continuously being generated by the land itself. The soil, the sun, the rain, these were nature's silent partners in his financial enterprise. This wasn't about the frantic accumulation of the moment, but about setting in motion forces that would continue to generate returns over extended periods. This principle of leveraging inherent cycles, of investing in things that have a long maturation period, is a foundational concept we will revisit throughout our journey. It's the idea that true, sustainable prosperity often involves an element of setting and forgetting, of entrusting your resources to processes that, with proper initial care and strategic foresight, will continue to bear fruit long after your direct intervention has ceased. Doesn't that resonate with a desire for a more peaceful approach to wealth? Now, fast forward and consider the early days of organized finance, a stark contrast to the sun-baked earth of Rome, yet driven by a similar underlying principle of patient accumulation. Picture a dimly lit stone building in medieval Europe, perhaps in a bustling port city. This is where the foundations of banking were being laid, not with sleek computers and instant transactions, but with ledgers, strong boxes, and profound trust, or perhaps a calculated assessment of risk. People began to deposit their savings, not to spend them immediately, but to keep them safe. And the early bankers, these custodians of capital, realized that this stored wealth wasn't just inert. They could lend it out carefully to merchants needing capital for voyages, to artisans expanding their workshops. The interest earned on these loans was a form of passive income, a revenue stream generated by money that was otherwise sitting idle. This was a pivotal shift. It wasn't just about earning from labor or from tangible assets like land. It was about earning from the passage of time itself, from the careful intermediation of capital. The deposited money, slumbering in the bank's vault, was like a seed, and the loans were the carefully tended ground that allowed it to sprout and grow. The bank, in essence, was orchestrating a process of growth that occurred independently of the direct daily efforts of the depositors. Their wealth was working for them, silently, through the economic activity facilitated by the bank. This concept of money working for you is a cornerstone of financial wisdom, and its roots lie in these early, often unheralded, financial innovations. How does this idea of dormant capital awakening through strategic lending and investment feel to you? Is it a concept you considered in your own financial planning, or does it present a new perspective? As we move into the age of exploration and burgeoning global trade, the scale of these principles began to expand dramatically. Think of the grand trading companies, entities that pooled vast amounts of capital from numerous investors, often individuals of considerable means who were looking for avenues to deploy their surplus. These companies financed perilous voyages, the establishment of distant trading posts, and the acquisition of exotic goods. The profits from these endeavors, when successful, were not immediate. A ship could be at sea for months, even years. During this entire period, the initial investment was tied up, yet the expectation was that it would return not just with original value, but with significant profit. The wealth was being generated through the complex interplay of logistics, risk, and the eventual sale of goods in distant markets, a process that unfolded over immense stretches of time and distance. The investors in these ventures weren't necessarily directly involved in the day-to-day operations of navigating ships or negotiating prices in foreign lands. Their role was primarily that of providing the capital, the financial fuel, and then patiently waiting for the wheels of commerce to turn and deliver their returns. This was a sophisticated form of deferred gratification, a testament to the understanding that significant wealth creation often requires patience and a willingness to let investments mature. The risk was high, certainly, but the potential rewards, amplified by the power of compounding over time, were immense. This era highlights how even in periods of great physical effort and risk, the financial machinery of investment and long-term return remained a powerful, often unseen, engine of prosperity. Have you ever thought about the waiting aspect of investment as a form of productivity in itself? The Industrial Revolution introduced a new, accelerated dimension to this story of patient prosperity. While it was characterized by the visible, often noisy machinery of factories and the relentless pace of production, the underlying financial mechanisms were also evolving. The construction of a railway line, for instance, or the establishment of a large-scale manufacturing plant, required colossal amounts of capital. This capital often came from investors who understood that building such infrastructure was a long-term project. The returns might not materialize for years, even decades. As the railway lines were laid, the factories were built, and demand for their products gradually grew. Yet, the anticipation of future earnings, driven by the transformative power of these new industries, fueled investment. Consider the shareholders of these early industrial giants. They weren't typically on the factory floor operating the machines. They were providing the financial means, the seed capital, and then allowing the enterprise to grow and generate revenue over time. The dividends they eventually received, the appreciation in the value of their shares. These were the fruits of a patient, strategic investment. It's a powerful illustration of how, even as the nature work became more industrialized and seemingly immediate, the principles of long-term financial growth, of allowing investments to mature and compound, remain profoundly important. This era really solidified the concept of equity, owning a piece of a growing enterprise, as a pathway to wealth that inherently involves waiting and allowing the business to flourish. Doesn't the idea of owning a part of something that steadily grows, independent of your daily effort, offer a unique kind of peace of mind? As we draw closer to our own time, the landscape of finance has become infinitely more complex, yet the fundamental principles endure, often in more abstract and rapidly evolving forms. The advent of what we now call high-frequency trading and algorithmic finance might seem like the antithesis of slow, patient growth. These systems operate at speeds incomprehensible to the human mind, executing trades in fractions of a second. However, behind these lightning-fast transactions lies a different kind of patience and strategy. The algorithms themselves are designed based on long-term predictions, on models that analyze vast datasets to identify patterns and opportunities that will yield returns over time, even if the individual trades are fleeting. Think of the development and refinement of these algorithms as a form of long-term investment in intellectual capital and computational power. The individuals and institutions that create and deploy these systems are investing heavily in research, development, and sophisticated technology, with the expectation of future profitability. The waiting here is not necessarily passive, but it is strategic. It involves a careful construction and continuous optimization of systems designed to capture value from market inefficiencies over prolonged periods. The money, in a sense, is still sleeping, in the sense that the purpose of the algorithm is to generate future gains, not immediate consumption, even if the mechanism for generating those gains is extraordinarily fast. It's a modern echo of the ancient Romans' understanding of cultivating assets for future yields, albeit executed with unparalleled technological sophistication. The concept of passive income, so prevalent in modern financial discussions, is a direct descendant of these historical developments. Whether it's through dividends from stocks, interest from bonds, rental income from properties, or royalties from intellectual property, the underlying idea is the same: generating revenue that requires minimal ongoing effort. This is the modern manifestation of money working for you, a concept that has evolved from the patient cultivation of Roman fields to the complex algorithms that never sleep. It's about understanding that true financial freedom often lies not just in earning more, but in structuring your financial life so that your assets are working diligently in the background, even when you are not. As you prepare to drift further into rest, consider this. The narratives we've touched upon, from ancient agriculture to modern algorithms, all share a common thread. They speak to the power of understanding cycles, of investing in growth that unfolds over time, and of the often underestimated value of patience. The world of finance doesn't cease to exist when you close your eyes. In many ways, It continues its intricate dance of growth and accumulation, powered by the strategies and investments initiated during wakefulness. This bedtime story, for adults, aims to plant a seed of understanding that prosperity is not solely a product of frantic activity, but also of strategic stillness, of allowing carefully cultivated assets to mature. Perhaps as you fall asleep tonight, you can ponder this. What seeds have you planted, consciously or unconsciously, that will continue to grow while you rest? What long-term investments in your finances, your knowledge, or even your well-being are designed to yield returns far into the future? The reflection itself is a form of gentle engagement, a way to integrate these timeless principles into your own life without the pressure of immediate action. Let these thoughts lull you into a state of serene contemplation, knowing that the pursuit of lasting prosperity can indeed be a journey of quiet cultivation, much like the deep, restorative sleep you are about to embrace. The evolution of wealth accumulation, beyond the mere passage of time or the initial investment, introduces a critical dimension of strategic divestment and resource reallocation. While we've explored how capital can grow, it's equally vital to understand how astute decisions to exit certain ventures, to cut losses, or to pivot capital towards emerging opportunities can be a powerful, often overlooked, engine of sustained prosperity. Think of a master gardener who doesn't just plant, but also prunes. Pruning isn't about diminishing the plant. It's about redirecting its energy, ensuring healthier future growth. Similarly, in the financial realm, the decision to sell an underperforming asset, even at a loss, can free up capital that can then be deployed into more promising sectors. This isn't about admitting defeat, but about acknowledging the dynamic nature of markets and proactively managing one's portfolio to align with evolving economic landscapes. Consequently, the ability to identify when to let go is as valuable as the ability to identify when to hold on. Consider the mid-20th century shift from robust manufacturing economies to the burgeoning service and technology sectors. Entrepreneurs and investors who recognized this tectonic movement and strategically divested from heavy industry to reinvest in nascent computing or telecommunications reaped considerable rewards. This wasn't just about holding on to established assets. It was about the foresight to understand when the sun was setting on one economic era and the dawn breaking on another. The capital released from fading industries became the fuel for entirely new avenues of wealth creation. On a more personal level, how often do we cling to possessions or investments out of sentimentality or fear of realizing a loss, thereby preventing our capital from pursuing more fertile ground? It's a question worth contemplating as you unwind. Furthermore, the very concept of risk management is intrinsically linked to the timing and execution of strategic divestment. It's not enough to simply identify a high-growth opportunity. One must also consider the exit strategy from the outset. This is particularly relevant when exploring speculative ventures or asset classes with inherent volatility. For instance, a venture capitalist might invest in a startup with the explicit understanding that their exit will likely occur within 5 to 7 years, either through an initial public offering (IPO) or an acquisition. The entire investment thesis is built around this eventual divestment, factoring in potential market conditions at that future point. Conversely, a long-term holder of established blue-chip stocks might have a far more fluid divestment strategy, perhaps only selling in response to fundamental changes in the company or the broader market. The differing approaches underscore that the decision to sell is not arbitrary. It's a calculated component of the overall wealth-building strategy. Building on this, the principle of opportunity cost becomes paramount when considering divestment. Every dollar or euro or yen that remains tied up in an underperforming or static investment is a dollar that cannot be put to work elsewhere. This is where the truly patient yet proactive investor distinguishes themselves. They are not merely waiting for time to pass. They are actively evaluating the best use of their financial resources at any given moment. Imagine two individuals who each invested a similar sum in real estate a decade ago. One holds their property rigidly, refusing to consider selling even as the local market shifts, perhaps due to changing demographics or economic decline. The other, recognizing these shifts, divests and reinvests the proceeds into a booming tech stock or a diversified fund. The latter individual, through their strategic divestment, has effectively multiplied the earning potential of their original capital by allowing it to flow to where it can generate a greater return. This proactive reallocation is a crucial, albeit less romantic, facet of enduring financial well-being. Another crucial layer to consider in this dynamic dance of wealth, beyond mere divestment, is the art of strategic leverage, how borrowed capital can amplify returns, but also magnifies risk, demanding a sophisticated understanding of financial instruments and market timing. This isn't about reckless debt, but about employing well-understood financial tools, like margin accounts or specialized loans, to increase the potential upside of an investment. For example, a real estate investor might not have the full capital to purchase multiple properties outright. By leveraging their initial investment with a mortgage, they can acquire more assets, thereby multiplying their exposure to potential appreciation. If the market rises, their returns on their initial invested capital are significantly higher than if they had paid cash for a single property. The key here lies in meticulous due diligence. The borrowed funds must be deployed into assets whose projected returns comfortably outstrip the cost of borrowing and, crucially, possess a resilience against downturns. Consider the private equity firms that thrive on this principle. They often acquire companies using a substantial amount of borrowed money, effectively using the target company's own assets as collateral for the loans. Their entire business model hinges on improving the acquired company's profitability and then exiting the investment, using the amplified gains from their leveraged position to generate substantial returns for their investors. This requires a deep understanding of operational efficiencies, market positioning, and, critically, an acute sense for when to exit the leveraged position to realize profits before interest payments or market shifts erode the advantage. Now, how does this principle of carefully applied leverage inform your own financial thinking? Does it spark an awareness of opportunities you might have previously dismissed due to perceived capital limitations? Or does it highlight the necessity of absolute certainty in your projections? Furthermore, the ethical and regulatory landscape surrounding leverage adds another layer of complexity that demands constant vigilance. As financial markets have evolved, so too have the regulations designed to prevent systemic risks associated with over-leveraging. Understanding these frameworks, from capital requirements for financial institutions to disclosure rules for public companies, is not merely a compliance exercise. It's integral to making informed investment decisions. For instance, a company that relies heavily on short-term debt to finance long-term assets might appear attractive during periods of low interest rates, but a sudden spike in rates could create a liquidity crisis. Investors who overlook these regulatory and macroeconomic undercurrents, which dictate the cost and availability of borrowed capital, are exposing themselves to amplified and often avoidable risks. This interplay between financial strategy and the external regulatory environment is a sophisticated dance that requires ongoing education and adaptation. Building on this, the psychological aspect of leverage cannot be overstated. The allure of amplified gains can be intoxicating, leading individuals to take on more debt than they can comfortably manage, especially during economic booms. Conversely, during downturns, the fear of debt can cause investors to deleverage too aggressively, potentially locking in losses or missing out on recovery opportunities. Mastering financial leverage, therefore, involves not only a grasp of financial mathematics and market dynamics, but also a profound degree of emotional discipline. It's about maintaining a clear head when the market is euphoric or in despair, and sticking to a predefined strategy for employing and managing borrowed capital. This capacity for disciplined decision-making, especially when faced with the amplified outcomes that leverage brings, is a hallmark of seasoned investors. Think about a moment in your own life, perhaps not financial, where amplified outcomes, either positive or negative, tested your resolve and decision-making. What lessons did you glean from that experience about control and consequence? Beyond the calculated employment of leverage and the strategic disengagement from diminishing assets, a more subtle, yet equally potent mechanism for continuous wealth generation lies in the principle of intellectual property and its monetization. This aspect focuses on a value derived not from tangible assets or borrowed capital, but from unique ideas, creative works, and innovative processes. Think of the intangible value embodied in a patent for a groundbreaking pharmaceutical, the recurring income generated by a best-selling novel through royalties, or the licensing fees for proprietary software. These are forms of wealth that, once created, can generate revenue streams for extended periods with minimal ongoing physical effort from the creator, provided they are effectively managed and protected. The initial investment here is in ingenuity, research, and development, time and mental energy, which then becomes a self-perpetuating asset. Consider the journey of a musician who crafts a song. The hours spent composing, recording, and producing are the foundational investment. Once released, however, that song can earn royalties from radio play, streaming services, and public performances for decades, long after the original creative burst has passed. The revenue is passive, a direct consequence of the intellectual property's enduring appeal and the legal frameworks that protect its creators. This concept extends far beyond the arts. Think of educational platforms offering courses on specialized subjects or engineers developing unique manufacturing techniques. The initial creation, the intellectual property, becomes a durable asset that can be licensed, sold, or exploited repeatedly, thus embodying the theme of prosperity that continues to generate value in the background. How does this concept of creating value that exists beyond the physical influence of its creator resonate with your own understanding of long-term asset building? Furthermore, the modern digital landscape has exponentially amplified the reach and monetization potential of intellectual property. The internet allows creators to bypass traditional gatekeepers and distribute their work globally with unprecedented ease. A software developer can launch an app that reaches millions of users, generating revenue through subscriptions or in-app purchases. A blogger can build a substantial audience and monetize their content through advertising, affiliate marketing, or selling their own digital products. The critical element here is not just the creation of the intellectual asset, but the strategic deployment of distribution channels and marketing expertise to ensure its value is realized. It's about transforming an idea into a marketable product and then ensuring that product has continuous exposure and appeal. This necessitates a shift in perspective, recognizing that one's knowledge, creativity, and unique insights are themselves potential revenue-generating assets. This isn't about immediate capital deployment in the traditional sense, but about investing in the cultivation and protection of one's intellectual capital. The legal mechanisms for safeguarding intellectual property, copyrights, trademarks, patents, are the financial scaffolding that allows these intangible assets to retain their value and command a premium in the marketplace. Without such protections, the fruits of intellectual labor could be easily replicated and devalued, undermining the very principle of passive, ongoing revenue generation. Consequently, understanding the legal and strategic aspect of intellectual property management is as crucial as the initial act of creation. This principle of intellectual property monetization also extends to corporate innovation and brand value. A company's brand name, its unique marketing strategies, and its proprietary processes are all forms of intellectual capital. The enduring loyalty of customers to a particular brand, for instance, translates directly into predictable revenue streams. This brand equity is built over time through consistent product quality, effective marketing, and positive customer experiences, an investment in intangible assets that pays dividends for years, if not decades. Consider how certain established companies continue to command premium pricing and market share, not solely based on the immediate utility of their products, but on the accumulated trust and recognition associated with their brand. The asset here is a reputation itself, a form of intellectual property that requires continuous nurturing and strategic protection. A profound, yet often less visible avenue for sustained prosperity lies in the cultivation and strategic leveraging of network effects. This concept, particularly relevant in our interconnected world, describes how the value of a product or service increases as more people use it. Think about social media platforms. Their inherent worth diminishes significantly if only a handful of individuals are active. However, as millions join, the opportunities for connection, information sharing, and even commerce grow exponentially, making the platform itself a vastly more valuable entity. The initial creation of the platform is akin to planting a seed, but its true wealth-generating power blossoms only when a critical mass of users is achieved, creating a self-reinforcing cycle where more users attract more users. Now, consider how this applies when you face the challenge of building influence or distributing an idea. It's not merely about having a compelling message, but about fostering an ecosystem where that message can propagate and gain strength through the collective engagement of its audience. Early adopters become evangelists, their enthusiasm drawing in subsequent users, and each new participant solidifies the network's value for everyone else. The wealth generated isn't just captured by the platform's owners. It's also embedded within the network's very structure, creating a durable, albeit intangible, asset. This is a form of wealth that grows not from individual labor, but from the synergistic interactions of community. Furthermore, this principle extends beyond purely digital realms. Observe the evolution of early marketplaces or trade routes. The more merchants and buyers congregated in a specific location, the more attractive that location became for further trade. A bustling bazaar, by its very nature, drew more commerce than a sparsely populated trading post. The network of relationships, the established trust between participants, and the sheer volume of transactions created an environment where wealth could be generated more efficiently and on a larger scale for everyone involved. The initial infrastructure, be a physical market square or a digital platform, served as a foundation, but the true value accrued from the dynamic interplay of the users themselves. Consequently, the strategic goal becomes not just to create something of value, but to design it in a way that actively encourages and rewards participation, fostering a robust network effect. This might involve designing incentives for users to invite others, facilitating seamless interaction, or ensuring that the platform's utility genuinely increases with each new member. It's about understanding that in many modern contexts, the most enduring and scalable forms of wealth are not built in isolation, but are emergent properties of interconnected systems. The wealth, in this sense, is distributed and amplified by the community, creating a powerful engine for sustained growth that operates independently of the initial creator's direct, ongoing effort. A further, often underappreciated, dimension to perpetual prosperity arises from the strategic cultivation of data as a core asset. In today's economy, the information gleaned from user interactions, market trends, and operational efficiencies is not merely a byproduct. It's a valuable commodity that can be refined, analyzed, and leveraged to generate continuous revenue or enhance competitive advantage. Think of companies that excel at aggregating and interpreting vast datasets related to consumer behavior. By understanding preferences, purchasing patterns, and even predictive future needs, they can tailor products, optimize marketing campaigns, and identify emerging market niches with unparalleled precision. This analytic capability becomes a powerful engine, driving repeat business and market dominance long after the initial product or service was introduced. Consider, for instance, how a streaming service analyzes viewing habits to recommend new content, thereby increasing user engagement and retention. This isn't a static recommendation. It's a dynamically evolving algorithm constantly learning from user feedback. The more data it collects, the more personalized and effective its suggestions become, creating a virtuous cycle. This continuous refinement of the recommendation engine, fueled by user data, represents a passive but potent form of wealth generation, ensuring that the platform remains indispensable and continues to attract subscribers without necessarily introducing entirely new, costly content every cycle. Now, reflect on how a deeper understanding of information flow, beyond simple data collection, might impact your own decision-making processes, both personally and professionally. Building upon this, the strategic commodification of anonymized or aggregated data presents another distinct avenue for ongoing income. While direct user data is often proprietary, many businesses can derive value by participating in broader data exchanges or by developing analytical products that offer macro-level insights. For example, a logistics company might analyze shipping patterns across various industries to identify bottlenecks or predict fuel cost fluctuations. The insights generated from this aggregated data, when packaged and sold to other businesses or stakeholders, can become a recurring revenue stream, independent of the day-to-day movement of physical goods. This transforms operational information into a liquid financial asset, generating value long after the initial logistical operations have concluded. Conversely, the risks associated with data monetization are significant and necessitate robust ethical considerations and compliance with evolving privacy regulations. The value derived from data is intrinsically tied to the trust placed in the entity managing it. A breach of this trust through misuse or security failures can irrevocably damage an organization's reputation and its ability to generate wealth from this source. Therefore, a commitment to data privacy and security isn't merely a regulatory burden. It's a foundational prerequisite for sustainable prosperity in the information age, ensuring that the asset can continue to be leveraged responsibly and ethically. The ongoing challenge lies in balancing the desire to extract value with the imperative to protect individual privacy, a delicate equilibrium that defines success in this domain. The expansion of enduring wealth also hinges on mastering the intricate art of strategic diversification and asset allocation, moving beyond a single-focus investment strategy to a multifaceted approach that buffers against volatility and captures growth across varied economic landscapes. This isn't merely about spreading investments thin. It's a deliberate architecture designed to ensure that as one sector or asset class experiences a downturn, others are positioned to compensate or even thrive, maintaining the overall momentum of wealth accumulation. Consider the seasoned investor who, having built significant capital in technology stocks, consciously allocate a portion to real estate for its stability, to commodities for their potential inflation hedge, and perhaps to emerging market bonds for their higher yield, albeit with a greater risk profile. Each component serves a distinct purpose, creating a robust financial ecosystem resistant to localized shocks. Now, think about how this principle applies when you are evaluating your own financial horizons. Are your resources concentrated in a way that leaves you vulnerable should a specific industry falter or a particular market trend reverse? Building a diversified portfolio is akin to cultivating a varied garden. Some plants flourish in sun, others in shade, and together they create a resilient and abundant landscape. This deliberate cultivation of disparate yet complementary asset classes allows for a more consistent and predictable rate of growth, significantly reducing the risk of catastrophic loss that can derail long-term financial objectives. Furthermore, the ongoing process of rebalancing a diversified portfolio is crucial, acting as a gardener's watchful eye, pruning and tending to ensure optimal health and yield. As certain assets appreciate more rapidly than others, the portfolio's original allocation can become skewed. Strategic rebalancing involves selling some of the outperforming assets to reinvest in those that have lagged, thereby bringing the portfolio back into alignment with its intended risk and return profile. This disciplined practice ensures that the portfolio doesn't become overly concentrated in any single area and forces a systematic buy low, sell high approach, which is often counterintuitive to human emotional responses. It's a vital mechanism for preserving gains and capitalizing on market corrections, ensuring the steady, almost imperceptible growth of wealth over time. The deeper implications of effective diversification and rebalancing also touch upon the psychological aspect of wealth management. By creating a portfolio that is less susceptible to extreme swings, investors can maintain greater emotional equanimity, making decisions based on long-term strategy rather than short-term market panic or euphoria. This psychological resilience is, in itself, an intangible asset that significantly contributes to the sustained growth of wealth. Consider a professional athlete who trains their body for peak performance. Equally, a strategic investor trains their mind to remain detached and analytical, allowing the carefully constructed diversification to perform its role without undue emotional interference. This capacity for reasoned action, underpinned by a well-allocated and rebalanced portfolio, cultivates a serene and enduring path toward financial well-being. Beyond the strategic deployment of capital and the judicious management of risk, a less conventional yet potent engine for sustained prosperity emerges from the realm of predictive analytics and foresight. This involves leveraging sophisticated data modeling and pattern recognition, not just to understand past performance, but to anticipate future trends, consumer behaviors, and market shifts with a degree of accuracy that informs proactive strategy. Imagine a retail giant that, through meticulous analysis of historical sales data, weather patterns, and social media sentiment, can forecast demand for specific products with uncanny precision weeks or even months in advance. This foresight allows them to optimize inventory, streamline supply chains, and tailor marketing campaigns, thereby minimizing waste and maximizing profit margins, a continuous cycle of financial benefit driven by predictive insight rather than reactive measures. Now, consider how this principle of informed anticipation can be applied to your own financial planning. It moves beyond simply reacting to market fluctuations and instead involves cultivating an awareness of the underlying economic currents and societal shifts that will shape future opportunities. This might entail staying abreast of technological disruptions, demographic changes, or evolving regulatory landscapes, and then strategically positioning your investments or business ventures to benefit from these anticipated transformations. For instance, an investor foreseeing the global shift towards renewable energy might not only invest in solar panel manufacturers, but also in companies developing advanced battery storage or grid modernization technologies, a multi-pronged strategy capitalizing on a single long-term trend. Furthermore, the capacity for predictive foresight is increasingly being democratized through advanced AI and machine learning tools. These technologies can analyze datasets far too complex for human comprehension, identifying subtle correlations and anomalies that signal future developments. Think of hedge funds that employ algorithms to detect micro-trends in financial markets, or urban planners who use data analytics to predict future infrastructure needs in developing cities. The ability to harness these predictive capabilities, whether through direct investment in such technologies or by understanding their outputs, provides a significant advantage in navigating the ever-evolving economic terrain and ensuring that one's financial resources are consistently directed toward areas of emerging growth. The wealth generated here is not merely from existing assets, but from the proactive capture of future value. Building on this, the cultivation of a long-term, adaptive strategic vision is intrinsically linked to predictive foresight. It's not enough to simply identify a future trend. One must also develop the organizational agility and strategic flexibility to capitalize on it effectively and adapt as the landscape evolves. A company that merely invests in electric vehicles without simultaneously planning for the necessary charging infrastructure or battery recycling solutions, for example, might find its initial advantage eroding as the market matures. True, sustained prosperity arises from a holistic foresight that anticipates not just the initial wave of opportunity, but also the subsequent waves of development, competition, and adaptation that inevitably follow. This requires a continuous process of evaluation, refinement, and a willingness to pivot as new information and insights emerge. As we transition from the deep exploration of wealth's myriad manifestations to a concluding perspective, consider the intricate tapestry we have been weaving. The countless threads, stretching from the ancient earth to the ethereal realm of digital algorithms, are not isolated strands but interconnected elements contributing to a grander design. We've observed how the steady cultivation of tangible assets finds its parallel in the nurturing of intangible value, and how the deliberate act of letting go can be as generative as the act of acquiring. These are not discrete strategies, but rather complementary facets of sophisticated, evolving understanding of prosperity that transcends simple accumulation. Reflecting on this journey thus far, one begins to perceive not a collection of disparate financial tactics, but a more profound rhythm. It is a rhythm that acknowledges the power inherent in patience, the amplified potential unlocked by astute leverage, and the self-sustaining momentum generated by interconnected systems. The constant hum of growth we've seen is not solely a product of visible effort, but meticulously orchestrated processes that unfold in the spaces between our most overt actions. This confluence of ideas suggests an emergent understanding of wealth creation, one that is both fluid and robust, responsive yet grounded in enduring principles. In light of these interwoven insights, the path toward a final contemplation becomes clearer. We are moving beyond the mechanics of individual financial instruments to grasp the holistic architecture of enduring prosperity. The silent, often unseen, forces we have discussed coalesce to form a picture of financial well-being that is less about frantic acquisition and more about cultivated resilience. The journey has illuminated not just how wealth is made, but how it is sustained, transformed, and continuously renewed, much like a natural ecosystem that thrives through cycles of growth, decay, and regeneration. As we pivot toward the final reflection, consider the cumulative effect of these explorations. It is akin to understanding that a complex melody is more than just a series of notes. It is a harmony, the progression, and the pauses between the sounds that create its resonant beauty. The insights we have gathered, when viewed in concert, form a comprehensive perspective that prepares the mind for a deeper integration of these principles into one's own approach to financial serenity and growth. We are now poised to synthesize these observations into a final, guiding understanding, preparing you for gentle descent into a rest that is both restorative and intellectually enriched. And so, as the echoes of history and the whispers of potential begin to soften, we arrive at a place of quiet understanding. The journey through the silent corridors of finance, from the patient soil of Roman estates to the lightning-fast calculations of modern algorithms, has revealed a profound truth. Prosperity is not merely an outcome of relentless effort, but a testament to a deeper, more nuanced engagement with time and value. We've seen how wealth can be cultivated through patience, amplified by astute leverage, protected by foresight, and sustained by the very interconnectedness of our world. This understanding transcends the transactional, hinting at a philosophy of financial well-being that is as much about serenity as it is about growth. The core insight that now settles, like dust motes dancing in a quiet sunbeam, is that true, enduring prosperity is an art of living in concert with cyclical forces, rather than in opposition to them. It is about recognizing that periods of stillness, of strategic divestment, and of allowing intellectual or network capital to mature are not voids to be feared, but fertile grounds for compounding value. The relentless pace of the waking world often obscures the quiet power that operates in the intervals, the time spent sleeping, contemplating, or simply allowing carefully laid plans to unfold. This has been the silent engine powering progress across millennia, a subtle yet potent force shaping fortunes while the conscious mind rests. The true practice, then, begins not with a sudden surge of activity, but with a shift in perspective, a gentle recalibration of how we perceive and interact with financial and creative resources. It's about cultivating the wisdom to plant seeds that will bear fruit over seasons, not just days, to build networks that strengthen with each new connection, and to leverage knowledge that continues to generate value long after its creation. This holistic approach fosters not just financial accumulation, but a deeper sense of peace, an alignment with natural rhythms that allows for both growth and serenity. As you drift towards rest, carry this understanding that while you sleep, the seeds of future abundance can continue to sprout, nurtured by the strategies and insights you have embraced. The most profound growth often happens when we are least actively striving, when we allow the carefully cultivated processes to simply be. This is the essence of prosperity that is both earned and effortlessly unfolding.